The nature of risk management. The previous example illustrates an important concept in exchange rate risk management. Its purpose is not to obtain the best possible rates. Its purpose is to provide certainty about cash flows. Always remember, when you try to protect yourself in foreign currency, never try to do speculation. Our purpose is not to make money. We don't want to make profit out of these transactions. What we are trying to do, we are trying to secure our position from here. It's just like you are buying a gun not to kill but to protect. So when you do such transactions, your objective should not be and should never be that how can I get benefit or how can I make profit out of this thing. My purpose is to, even if I have to pay something extra, I'm paying extra, but I'm just protecting my position. When you pay insurance, it has a cost. And the purpose of when I do insurance for my house or for my car, I don't hope or I don't expect to get any benefit out of that. I mean, I'm not going to get any cash out of that. It's just that I'm, avoiding any risk. The same happens here, that you may have to pay something in forward contracts or future contracts. And the purpose is not to make money, but the purpose is to pay some cost if it is needed and provide certainty about your cash flows. You don't get any surprises, okay? For example, it's a transaction risk. A Malaysian company will receive $20 million in 4 weeks and must pay out $18 million in 5 weeks. So they are going to receive 20 million in 4 weeks, 4 weeks time. And then in 5 weeks time, they have to pay $18 million. So they have a receivable, which is coming in for 4 weeks, and they have a payable, which has to go out in 5 weeks. And it's a Malaysian company. Exchange rate transaction risk is substantially eliminated by opening a US dollar bank account and using the receipt of 20 million to pay the 18 million. It works best if there are many inflows and outflows to give opportunities for matching. So this is called matching your assets and liabilities. If they don't have a USD bank account, when they receive this 20 million in their local currency account, it will automatically be converted into local currency. And then after 1 week, they will have to take out the local currency, convert it into the USD, and then make payment. So of course, they are making 2 times conversions. So if they do not have a local bank account, if they do not have a USD bank account, they will lose money on 2 conversions, from USD to Malaysian currency, and then from Malaysian currency to USD currency. So 2 conversions, bank will get benefit. That spread, if you remember, bank will get the spread in both times. And secondly, it is also possible that Malaysian currency may become weaker in next 1 week. So then they will also face the risk of weakening currency. So the better idea is open a bank account, keep your USDs, don't convert them into Malaysian local currency, and then pay it back. Netting receipts and payments. C and D are respectively South African and US based subsidiaries of a UK holding. So 2 subsidiaries. If C owed 300,000 sterlings and D owed 220,000 sterlings, the 2 intercompany balances can be netted off, leaving a net debt owed by C to D of 80,000 pounds. So you can net off your intergroup transactions because C owes D and D owes C. So you are now only coming up by 80,000 sterlings. So there is no need to that he makes in payment of 220, then he sends back 300. So because there is a 300,000 payment which I have to make. So if I send them 300,000 and after a few weeks they send me back 220,000, so that does not make sense. It's going to be, both subsidiaries are going to lose money on conversion. The better is that you net off and they transfer 80,000. C transfer 80,000 pound today. That's very simple, but you need to know. Forward contract, we already discussed. A forward contract sets in advance the rate at which a specified quantity of currency will be bought and sold at a specified date in future. We know that we buy currencies in future, like $1 million after 30 days, $1 million after 60 days. And a forward contract is binding. I told you before that futures are not binding. Forward must be executed. They must be delivered or paid. Currency must be delivered. You don't get the difference, you get actual currency. So forward rates can be specified in several ways. The 3-month dollar to pound rate is 1.5231 to 1.5425. 1.5231 is the guaranteed rate you would get for changing pound to dollar in 3 months. The 3-month dollar to pound rate is 1.238 plus minus 0.0097. So your plus minus means that you plus this 0097 and you get the buy rate, and you minus it and you get the lower rate, like this. So they took at the middle point. So this is minus, this is plus. So these are the two rates which you get. It's the same thing actually. It's just a different way of expression. Okay, let's do a question. A UK company has made a sale to a US customer for $5 million. Payment will be received in 3 months. So UK company is selling to a US customer for $5 million. The company will protect itself against exchange rate risk by taking out a forward contract to deliver 5 million in 3 months. Now, you know what is happening? You have the seller is a UK company and the seller currency is GBP. Customer is going to give in dollars. Now, if a customer gives $5 million to a UK company does not need dollars now. Whenever they receive dollars, they will convert them to pounds. And there is a risk. They do not know that after 3 million, if they get $5 million, how many pounds they can get. That is the situation. I know that I will get $5 million, but I'm not interested in dollars because my local currency is pounds. So, and I'm not sure that after 3 months, how many pounds I can get with 5 million. And I want to secure my position. I want to know my cash flow. I want to make a certainty to my cash flow. So what you do, the company will protect itself against exchange rate risk by taking out a forward contract to deliver 5 million in 3 months. So you go to some, bank and you tell them that I will bring $5 million to you after 3 months. You make a contract to me now. So I'm selling dollars to them. So 3-month forward rate is 1.5299 and 0.0006. So these are the rates I get. So I already know that after 3 months when I will go, what will happen? There are no surprises. There are no question marks. It's clear because I already agreed my rate. I said that I will have dollars. I will give you dollars. Tell me how many pounds you will give me. What is the receipt from the transaction? Now you guys have to tell me. These are the rate plus minus. Make it 1.5299 plus 0.006 and 1.5299 minus 0.006. Two of these rates. So how many pounds you will get? Who will tell me? Make a quick calculation, please. I need your input. Find out the two rates and tell me the input. So you should be getting more pounds. The bank will give you more pounds or less pounds. So if you have to get less pounds, the number with which you are dividing should be a bigger number or a smaller number. It is here 5 million USDs. And I have to convert 5 million USDs into pounds. So it should be the bigger number or the smaller number. So you have to add it because so that part was correct, that you have to take a bigger number. 1.5299 plus you have to do because, and you know that it is dollar to pound, whatever rate is like 1.5293. Changing $1 gives 1.5293, but it costs 1 to yield 1. So 3.266906. This is the number of pounds you are going to get. In the previous example, the company entered a forward contract to deliver the bank 5 million in 3 months, and the bank would exchange that for 3.266906. This is binding on the company. If the sale falls through and 5 million is not received, the bank still expects delivery of 5 million pound, okay? The company has to close out the contract by buying 5 million on the spot market and then converting it back under the forward contract. Because forward contracts, like I told you before, that these are binding contracts. They must be executed. Okay, money market hedging. The result is very similar to forward contracts, but the process is quite complex. Now, we are going to do money market hedging. Now, that's a different thing from forward contract. Please keep these things separate. They ask you in exam, use money market hedge or use forward contract. You need to understand the difference. In money market hedging, the risk is eliminated by changing the currency now rather than when it is received or paid. We need to look at two cases, receiving a foreign currency amount and paying a foreign currency amount. So we are going to see what happens with receipts, what happened with payments, and now we are going to see how we do it with money market hedging. Okay, so this is the scenario. Please pay attention. A German manufacturer will receive $5 million in 3 months. Now, you know that it's a German manufacturer. He does not need dollars. He will get dollars, but he has to convert it to their local currency, German mark or euros, whatever they are using. So he is going to get this money in 3 months' time. So what he does here, it says borrows enough USD now to become 5 million in 3 months after interest charged. The loan grows to 5 million in 3 months, and then he converts the US amount borrowed at the spot rate. The German company now has a definite risk-free amount, and he gives the US $1 million. You know what happens? I know that I am going to receive 5 million in 3 months. So that is for sure. So what they do, they today go to the bank and they take a loan of 5 million. A loan, some amount of loan like 4.7 million, 4.8 million, which will after interest, which can become 5 in 3 years, in 3 months. So they already get their dollars today. So they get 4.9 million, for example. And that 4.9 million, they immediately converted to into the local currency, which is euros. So their risk is gone. And now they have a liability of 4 million with the bank. They have a liability of 4.9 million with the bank. And this 4.9 million plus interest in 3 months, it will become, in 3 months, it will become 5 million. Then they receive 5 million. They receive 5 million from customer and they pay to the bank. I just got my money in advance. I'm a German company. I know that I have to receive 5 million after 3 months. What will happen to euros in 3 months? I don't know. So I go to the bank and I take a loan. For example, 4.9 million. I know that after 3 months, the bank will charge me interest, and this 4.9 million will ultimately, in 3 months' time, it will become 5 million. And in 3 months, my customer will give me 5 million. I'll take 5 million and I give to the bank. I took the bank, I took the loan in USDs. I took loan in USDs. I receive USD from customer and I close my bank. I already got my 4.9 million today. And I got risk-free because I take my 4.9 million today USD, I go to the market and I convert it to euros. What I am losing here is this thing. What I'm losing here is my interest because I have to pay interest to the bank. Am I clear? Please tell me if you understand this scenario or not. Abhilash?
Yes, sir.
Abhilash, is it clear? Okay, Abhilash, Binto, Farooq, Sumaya, and Marissa. Is it difficult?
No,
Okay.
sir, it just takes some understanding.
So, I mean, you know what happens? Because I know that I will get 5 million after 3 months. So instead of waiting for this 5 million after 3 months, I go and I take a loan in dollars from the bank because I will get dollars. So I take a loan from the bank. I'll say I will pay you 5 million in 3 months. And then I don't take 5 million. I take little less than 5 million. I take an amount which will become after interest 5 million in 3 months. So I took 4.9 million, for example, or 4.95 million, or 4.99 million. So I took 4.99 million, 100,000, I will pay interest. And this 4.99 million, I take it, it's a cash in my hand today. So I get 4.99 million dollars today, dollars. and I immediately go to the market and convert them into euros. So now my risk is not there. My risk is not there. The only thing which I have to pay is my interest, and that also is 100,000. I know it now. So there is no risk. There is no gray area. I made everything clear. I put a cost of interest, cost of 100,000, which I'm going to pay to the bank, but I get my cash today. I converted it today in euros, or probably I will put this money in the bank and I also can earn some interest to cover this interest cost. This money which I take loan from one bank, I convert it into euros, put it in another bank, I earn some interest, and then I pay this interest. My risk is gone. This is very interesting transaction if you understand. Now let's do the numbers. Let's do the numbers, If you have some confusion, please ask me here, because this is interesting and quite possible in exam. This is called money market hedging. So you are not buying a forward contract, you get your currency today in form of a loan. Okay, so this is a question. A German manufacturer will receive $5 million in 3 months. Spot rate for euro to US dollar is 0.7524. US 3 months interest rates are 2.5% to 3.2% per annum. So if I take a loan from the bank, this is what I have to pay. And euro 3 month interest rate is 0.2%, because the money which I will take loan from the bank in terms of dollars, I will convert it to euros and I put it into the bank. So I'm going to earn this interest rate and I'm going to pay this interest rate. Show how exchange rate risk can be managed using money market hedging. So you borrow enough dollars now to become 5 million in 3 months. The bank will charge 3.2% for borrowing, because these are two rates. This is if you put money into the bank, they give you. If you take money, they charge you. Bank has two interest rates, one which they give, one which they take. And of course, which they take is more. So 3.2% is your rate. You have to pay to the bank. This is always quoted for 12 months. It is annual. But you need to apply for 3 months. Therefore, borrow X dollars. So this is your formula. If you remember, we use this same concept. We use the same concept many times. We said that always you have this formula, that forward value is equal to present value into 1 plus I, power n, if you remember, in discounting and compounding. So here my forward value is like which I need, and present value, forward value is 5 million, present value I need to find out. So I want some amount which will become 5 million. How much of that amount will be? And this is 1 plus 0.032. This is my annual interest rate, and I divide it with 4, which means 1 quarter, and I say, this is my interest rate. And based on this, when you will calculate your numbers, this is the same formula for discounting, compounding, present value, future value, if you remember. We did it many times. And if you remember, when we were doing our dividend growth model, dividend valuation model, I we put as growth, G you can put it as I. And many times I told you that this formula you will use in many places, wherever you have to find out a future value based on a present value and interest rate. So based on this logic, we understood that we need to take out a loan of $4.96 million from the bank, and in 3 months' time, at 3.2%, it will become 5 million. So this loan I take from the bank today. I'm going to take a loan of this loan from the bank today, and I immediately take it to the market and I convert it to euros. And those euros I will put into my bank, and I will start earning some here. So I will earn interest from this bank and I will pay interest to this bank. The difference of these two, interest income and interest expense, will be my cost of this transaction. So I just get rid of any uncertainties. So let's see it forward. So 4.960 million. And then what happens? Step 2. 4.960 million at the spot rate of 0.7524, you get dollars, you get euros 3.72, because your euro dollar rate is 0.7524. So again, they give you one rate or two rates. If they give you two rates, you can choose, but they are giving you one. So you take 0.7524. So this is the number of euros you will get. So you already have this euros in your hand. The loan of 4960 will grow to 5 million in 3 months, and the 5 million receipt from the US customer will pay this off precisely. Using a dollar receipt to pay dollar will not involve exchange risk, because the customer will pay in dollar and I will straight take this money to the bank. Here is your money. And what will happen, that this 3732, which I got my euros from here, I am not going to leave them at home. I want to put this money in the bank. So this 3 month, this money I also put it into, either you can spend it now or you can put it into the bank for 3 months to match the time of the receipt. And this I put into the bank, and this is the interest rate which I'm going to get, and it will become 3734. And this is the difference which I make as my interest income. If there is any confusion, please ask me. A very typical exam question of money market hedging. Money market hedging means that you take out a loan, you convert it into your own currency, and you start earning interest on that. And this loan will grow into your liability, and you receive from customer and pay it. So now another question. I told you that we had to do money market hedging for two things. Money market hedging, we had to do it for receiving and for payment. So we just did it when you are receiving the amount currency, or you may have to pay foreign currency amount. Farooq, are you there? Can everybody listen me?
Yes, sir.
So this money market hedging, which example we did, this was when you were receiving a foreign currency. Maybe you are paying a foreign currency. So if you are paying a foreign currency, then what will happen? So this is the scenario. A UK importer must pay US dollar 10 million in 3 months. So now you are a UK importer. Now remember that you are UK importer. You are UK importer. So your local currency is pound, and you have to pay dollars. So you have to pay it in 3 months, $10 million. And you do not know that what will happen between dollar and pound in 3 months' time. And you want to secure your position. So what should I do? So your way is that it says that deposit enough US dollar now to become $10 million in 3 months after interest earned. Step 2 will happen. So what you will do, that deposit grows to $10 million in 3 months, and you pay to your supplier. So you are converting pounds now to the required US amount to be deposited. So now before you were taking out the loan, now it is opposite of that. So you may again take out a loan in pounds and you convert it into, USDs and put it into the bank. Let me erase this thing. So see how we are going to do it. So it's the opposite scenario. So a UK importer must pay 10 million pounds in 3 months. Spot rate for dollar and pound and sterling and USD is 1.5123. US 3 months interest rates are 2.5%, 3.2% like before. And pound sterling 3 months interest rate is 1.6% and 4.2%. Show how exchange rate risk can be managed using money market hedging. They are not asking you to do it using forward contract. You have to do it using money market hedge. And you must pay attention to the question that you are not receiving a foreign currency. You are a UK importer. You have to pay a foreign currency. Receiving a foreign currency and paying a foreign currency are two different scenarios. You are paying foreign currency. So what you should be doing in this scenario, So to have US dollar 10 million in 3 months, the company has to deposit X dollars at 2.5% now, because the dollar rate which the bank is giving you, before we took 3.2%, because before you were borrowing money from the bank. Now you are putting money in the bank, and the bank will give you interest rate 2.5%. So you should be clear on that which interest rate you are going to use, not 3.2. Before you took a loan, so you took 3.2. Now you are putting money in the bank will give you 2.5%, the lower rate. So again, I'm using the same formula. Present value into this one is equal to future value, and we get the number 9937. I'm sure that I don't need to explain you this formula, okay? I mean, I really don't want to spend time on explaining this formula. We already know that future value is equal to present value. Okay, you guys do not speak, so I have future value is equal to present
Yes,
value.
sir.
Okay, 1 plus I, power n. And in this case, your future value is again 10 million. This is for sure. You need 10 million. And how much you should take loan now, I don't know. Or how much should I deposit into the bank, I don't know. And plus 0.025. And that's what I'm going. And by the way, divided by 4, because that is annual rate. So by this way, you will find out this X. And this X is what? This X is the amount of money which you should be depositing in the bank. So if you deposit 9.939 million, 9.937,888 million in the bank today, at 2.5%, it will become 10 million. So you will pay this 10 million in 3 months' time. Now, the question is that if you put this money in the bank today, where this money will come, and what is your cost? So 9937 can be obtained now at the spot rate of pound and US dollar 1.51. So you need this much of dollars. You go to the market and you convert it. And again, you have the rate, one rate they have given you. So you need to have 6.567 million pounds in your hand. So if you have got this much of pounds in your hand, you can put it into the bank, and 937. And by the way, this 9937 will become 10 million. So actually you are earning some interest here, because the bank is giving you 2.5% profit. So your money is increasing. So here you are getting your interest income. Okay, so when you put, because you put less money in the bank, and it became 10 million, so I can see it is 9.937. So this is something like 63,000 or $62,222 interest you earned. Actually 62,000, you made profit out of that. And that profit will be offset. This, you may be earning some money from here because you are putting in the bank and you are earning interest, but you may also be getting interest cost, because this much of pound, where did you get this pound? Did you have with you or not? You may not have it, so you can go and borrow this amount. So this actually is telling us that we need 6.571 million pounds today to settle off this liability of 10 million in 3 months. Now the question is, where is the 6.57 million? What do I do? Do I have it in my bank? Okay, very well. If I don't, I go and I take out a loan of this amount. So of course the company has to find 6.57 million now, 3 months earlier than the supplier needs to be paid. The true cost of the transaction should take into account the cost of borrowing this amount for 3 months. So on one side, you will have the cost, interest cost, which you will pay on this borrowing, which is your pound interest rate, 4.2%. Remember, you are borrowing, so 4.2% will apply. So this is going to be my cost, 4.2% over 6.57 million. And on the other hand, I will have my interest income on USD account. So this is your 4.42, 0.042 divided by 4. So this is your after interest total cost. Okay, is it clear?
Yes, sir.
So we made some interest income also. our objective was not to make income, but we did make income. I mean, the difference of 10 million and 9.9 is my interest income. And the difference of 6.571 and 6.640 is my interest expense. And I will make this plus minus. Whatever is the net answer, that is the cost of this transaction. So the cost of transaction will be the difference between interest income earned on USDs and interest expense paid on GBPs, and whatever is there. And of course, there will be some expense, and we are ready, we are willing to pay that expense, because our purpose was not to make money out of that. Our purpose was to, make our position secure, and which we have done successfully.